All right, let's move on to the broader markets. The S&P 500 is pacing for what would be, at least if it maintained what it's doing right now, a third straight day of declining. Still, although we're very close to record levels, joining us with his outlook is Michael Kantrowitz. He's Piper Sandler's chief investment strategist. Nice to have you here, Michael.
Thanks.
You write that you expect improving EPS breadth to take over after 3 years of PE expansion. Can you explain what that means and why that's a positive?
Sure. Well, in 2022, the markets went down. The majority of that was multiple compression because of inflation. And it took about 2.5 to 3 years to get multiples back even slightly above where they were back in 21. And we basically are at a point now where there's very little macro risk priced in. There's not much worry about tariffs, not really much about rates, tightening, inflation, recession. So it's hard to see further tightening in credit spreads and more multiple expansion. Earnings are going to have to take over from here, and as long as employment looks okay and GDP is okay, we should continue to see earnings improve. I think it's going to be broader. We've already been seeing this for 2 months. It's not just large caps, not just Mag 7, but some more breadth than we've seen in the last 3 years.
And what signs do you point to show that that actually will come through, let's call it, in the second half of this year, but even more importantly, the first half of next year?
Sure. We look at things that lead data like that. So the fact that interest rates have been stable to slightly lower over the last 2.5 years is giving us evidence that we should see, basically, there's tailwinds in the economy now. Globally, there's been like 95 rate cuts around the world in the last several quarters. We've got oil prices that are exceptionally low. And we're starting to see analyst estimates start to broaden out. We're seeing some of the housing data stabilize to slightly get better. PMIs around the country have been stable to slightly better as well. So we try to corroborate the micro, the macro, and what the message from those leading indicators tell us. And everything kind of lines up to 26 should be a little broader than we've seen in the last few years.
Led by,
well, from a sector perspective, stock perspective.
Sector.
We're still going to have to compete, or the breadth story is still going to have to compete with a very strong secular AI story. But you're seeing rising small cap and mid cap earnings estimates for the first time in 3 years. We're seeing housing stocks respond, obviously, to better rates when rates are coming down. So I think there's a rate story here. And I think there's a broadening economic story here. I think some of the manufacturing parts, transportation, things that have really lagged for 3 years, I think can make some catch up. I think we're in this Goldilocks backdrop today where labor data is soft enough to allow rates to come down, to allow the Fed to gradually cut rates, not too cold, and the economy is not too hot. After an inflation shock, you want a softer labor market to allow rates to come down, to help broaden things out going forward. And I think that's where we are.
I feel like we come into every year with the expectation of a broadening and or the equal-weighted S&P is going to do better, even the Russell and things of that nature. And we see periods of it, but then ultimately it all goes back to the big growth companies. I mean, I just do wonder what's going to be different this time.
One of the things that is already different in hindsight is the broadening of earnings estimates. For the last 2 months, we've seen very strong broadening of mid, small, large caps. So that's one thing. Again, we're seeing some green shoots in the housing data, purchase applications, refi activity. It just continues to grind higher. So every time you see a weak labor report, not this week, what you see is rates come down, and that's when you get that excitement of potential breadth. The difference today compared to a year or 2 years ago is that rates haven't gone anywhere in 2.5 years. The Fed funds rate is 125 basis points lower, probably another quarter point lower by year end.
Michael, going to leave it there, but always appreciate it. Thank you.